So the third quarter for GDP came out for the United States yesterday, and the data was more of a mixed bag, but it definitely confirmed my analysis that I had been giving you in the previous weeks leading up to this, that we were seeing a strong slowdown into GDP, especially on the real GDP growth caused by rising consumer prices, eating away at the increase in expenditures, as that is technically speaking how we measure gross domestic product for our economy. Now, I've given you my take on this over and over again, that I believe it has to do with increases in government spending eroding from the production side of the economy, which is now filtering down to the consumption side of the economy once you adjust for prices. But here, it's not as strong as what, say, the Atlanta Fed was estimating the slowdown to go to. And my analysis was not quite as pessimistic as what the Atlanta Fed was forecasting, with a 0.2% GDP. I was forecasting maybe like a 1 to 1.5%, but it came in at 2% annualized rate of growth. Now, in a normal economic situation, when you have an economy that's just steadily growing, 2% is not really all that bad. Technically speaking, as a rule of thumb, you want the economy to grow at about 2% or more to at least keep up with the rate of population growth, and also to factor in some type of increase in the standard of living. If it's less than 2%, standards of living for people, as we measure on a numerical scale like GDP, is not really increasing. So people are not really getting wealthier per se. It's probably more to an influx of the population, and there may be some other statistical discrepancies. You know, maybe certain classes or groups of people are getting more of the wealth than others, aka the top 10%, the top 1%, so to say. One of the things to take note, though, is that the BEA, the Bureau of Economic Analysis, points out that the deceleration in real GDP in the third quarter was more than accounted for by a slowdown in the PCE. So in their minds, consumption was dropping, the growth rate of consumption was dropping, and that contributed to the deceleration in real GDP. I'll go over why I think that's happening in just a second. But the current dollar increased at an annualized rate of 7.8%, or 432.5 billion. Let's concentrate on that. So nominal GDP at an annual rate was increasing 7.8%. Okay, that seems like a really big number. But when we adjust for consumer prices, whether we're using the Fed and the Bureau of Economic Analysis preferred inflation adjustment called the PCE deflator, or the GDP deflator, which is basically the PCE chained price index, or whether you use the consumer price index, you can see here that on real GDP in blue, the growth rate has slowed, okay? So what I have done is overlaid this with red, which is what I call NDP, or net domestic product. So to recap on that, it's basically gross domestic product minus consumption of fixed capital. It's what you're using up in fixed capital goods to get that product sales number, that final sales number, and then I adjusted for it on consumer prices. But to really illustrate the point and hammer it home, let's take how much it increased quarter to quarter here. And keep in mind, this is a quarterly growth rate, not an annualized growth rate, okay? So a 7.8% current dollar-to-dollar growth rate is about 1.5% annualized growth, give or take. It may be a little bit more than that, okay? But when we take a look at gross domestic product and NDP, the quarterly growth rate is no longer over a percent or 1.5%. Real GDP is down to 0.5%. That's what increasing in prices does to economic expansion. Okay, so in other words, this would have been equivalent to a 2% real gross domestic product jump. So if our economy were to just have flat prices for the third quarter, then our GDP would not have increased by 0.5%. It would have increased by over 1.5% in just one quarter. So instead of a 2% real annualized growth, we would have gotten a 7.8% as estimated by the BEA. So price increases is eating up nearly 75% of economic growth right now. And as the rates continue to increase caused by the supply bottleneck shortages driven by federal stimulus, monetary stimulus, the shutdowns relative in certain states, the pandemic, as people are afraid to go back into certain industries of work, those discoordinations that are going on, the COVID vaccine mandates, all of that is having disruptions in our economy, and we're beginning to see this. But take a look at what net domestic product is doing. When we adjust for consumer prices, net domestic product barely increased in the third quarter, 0.1%, an annualized rate of like 0.4. That is dismal. That is flat. That's basically close to a contraction, obviously. But my point is that, we're really seeing the drawdown when we factor in consumption of fixed capital, and that's important because we get GDP by subtracting out capital goods on the intermediate level. Think of it as variable capital, but we're not calculating what we're consuming of fixed capital, of fixed assets. So land, trucks and cars and vehicles, property, all those depreciations are still being counted in gross domestic product. But once you strip that out and you adjust for that depreciation, then you really see that the net value added of what we're really contributing to the economy is virtually down to zero. And that's a real issue that we're going to be facing in the coming quarters. So net investment wise, so net investment is your gross private domestic investment, which is the private investment component of GDP, the one thing that I consider the most important factor in GDP. When you subtract out consumption of fixed capital, your net investment is lower than what we were seeing pre-COVID. That's no surprise there. Higher government spending is eroding the savings rate. And the savings rate is what the net savings rate now, once you count in government deficits and personal savings, is what I believe drives this net investment rate. And I've got a chart here to show you the correlation. If I point this out right quick, I'll go ahead and show this to you. And then we can let's subtract out consumption, fixed capital, and subtract. And see, there you go. Now you can see the correlation between the two. So when you take a look at your net savings, it started dropping in quarter two. Really started dropping since quarter four. That's when your net investment dropped. There's definitely a strong parallel here. Now, for a while, your net savings rate has been higher than your gross private domestic investment. I think a lot of that has to do with banks stuffing money into reserves at the Fed. That's kind of, making up this difference here. Because we're not seeing the high investment growth like we were seeing before 2008. So before 2008, your net domestic investment and your net savings was very highly correlated. But post 2008, that's not. And that may be because of the extenuating circumstances of expanding the balance sheets at the Fed, and yet loan creation has been relatively lower. So the Dodd-Frank restrictions bills may be having a factor in there, the capital requirements of the Fed, especially with the fact that banks are forced to purchase now more and more treasuries to hold on books as collateral. So more of the money is going to the government and counted in the government expenditures, gross government component of GDP, instead of just straight business investment there. Now, moving on from here, you can see that government total expenditures dropped from quarter two to quarter three. Now, these are annualized government numbers, so we really didn't drop by $300 billion. In reality, we probably dropped by, like, say, $75 billion, give or take, But we did see a drop in government spending. So That should have boosted net savings for quarter three, but we're not going to get that out for a couple of months. One thing to note here, though, and I've got to pull it out, maybe it's in here, is the savings on here. Let me see here, personal savings. Personal savings dropped, and this is annualized, by $300 billion as well. So again, that's $75 billion. So in reality, your net savings is pretty flat. And yet we saw net investment increase a little bit. That's not really surprising because there's been this huge lag between the two for quite a while, and as long as there is a lag, we're going to see this lagging growth, because until net investment starts to really build, we're not going to get those higher GDP numbers like we were seeing during the 1990s and the 2000s and so on and so forth. Now, when we take a look and break down gross domestic product at its components, now we see that although the real GDP number is an annualized rate of 2%, and again, that's not good considering our economic situation and all that, but it's not necessarily terrible, especially it wouldn't be bad on a normal situation. But when we start looking at the breakdown of what's contributing to this 2% growth, things start looking a little bit worse for wear. So one of the things I want to take note here is that personal consumption expenditures, so personal spending, has dropped. Now, normally personal spending doesn't really bother me, because as long as people have money and lots of it, they're going to spend. They're going to spend. And obviously, compared to the previous quarters, you can see the effects that stimulus spending has had on the PCE. It definitely jacked it up in quarter one and quarter two. That's what contributed to the high GDP numbers there. It's tapered off in quarter three substantially on a real adjusted level. Part of that's price increases, and part of that is the fact that that stimulus money is coming to an end. I consider that a good thing. I consider that the less that we consume, the more that is left over for investments through savings, okay? But I want you to take note of what we are consuming less. We're buying less goods and we're buying less non-durable goods, but we're having a high increase in services here, okay? So we're purchasing less hard product, and instead we're paying more for convenience and things instead of the actual hard product. And that's an interesting thing to take note here. Services are derived from goods production, okay? So in my opinion, this kind of discoordination is not healthy in an economy, because what you should be seeing is if people are spending, they should be spending more on goods and services, okay? If we're spending more on services and less on goods, then we're spending more on the means of bringing goods to us rather than the goods themselves. Now, this money is draining away from goods-producing sectors. It's getting hit on the retail sectors for goods. And what we really need to see is allocations of money going into goods-producing sectors of the economy, so that way services can be supported from it. If you take note of what happened before COVID, the goods-producing sectors and services grew together. And that's the way that it should be. What we're seeing now is that goods have contracted and services are still increasing. Now, one quarter, a trend does it not make. But if we see this going on for quarter after quarter, this could reflect a real problem, because what it may be signaling is that a lot of the bottlenecks and shortages are beginning to catch up to us, that we're not able to purchase an increase in goods without factoring in higher prices for those goods versus the services relatively of acquiring those goods, okay? So purchasing the goods themselves, those goods prices are beginning to spike and increase, and that could become a real problem or be a symptom of a real problem in the economy. Now, gross private domestic investment increased by a whopping 12% from the previous quarter. Notice that the private domestic investment contracted in quarter one and quarter two. That's the effect that stimulus bills have, and that's a reason why I do not hold stimulus spending in very high regard. It definitely takes away from that business sector. Now, normally I would be giddy and jumping for joy over a 12% increase in private domestic investment. I think this is fantastic, wonderful. But where's the increase coming from? Well, let's take a look. Is it coming from fixed investment? No, not really. It is coming from non-residential investment, whatever that means. Okay, so that means it's not coming from housing. So let's take a look at what's coming from housing. Well, dang, housing investment contracted by 7.7%. That's hard contraction. It already contracted hard in Q2. So when you adjust for prices that's going on in the residential sector, we're seeing a hard contraction in private domestic investment. That's the prices of property and land going through the roof, and a lot of that is having to do with the housing sector that's been going on. But instead of seeing an increase in production, an increase in investment to create more houses, we're seeing a decrease because basically costs are increasing faster than the price of producing the residential properties. As long as we continue to see this negative, we're probably going to see housing prices continue to spike. Last time that we saw this positive was in Q1 2021, and my guess is that that was probably before we saw a lot of the increase in housing starting to pick up. So if we take a look at the government's housing price index, let's see it when it started to pick up. Here's Q4 2020. Here's Q1 2021. We were still seeing a positive residential investment, but then we see the Q2 and we see the escalation and the jump. So if we were to take the percentage change here, we see that it's been growing at 2.2% per quarter, which is still a high inflation, but then it jumps in Q2 to a whopping 5.33% in one quarter. That's like a 20% inflation rate when you annualize that, and that's what's causing this drop here in this residential investment. So in the non-residential investment, it has to be our whopping 11.7% growth. But where is it? Well, it's not in structures. That makes sense because land and property is going up. It's not in equipment. It's in something called intellectual property products. Now, what's intellectual property products? Well, the Bureau of Economic Analysis defines that as intangible fixed assets. Well, that really clears things up. But really what it is that it is research and development. It's R&D. It's developments of new software. And then it contains literary and artistic originals, which I don't really care for. But it can also include mining exploration and other kind of minor things. But the point is that these are long-term investments. These are not short-term investments that are going to yield short-term returns. Now, long-term investments are very important. They very much create stability. We do need R&D. That's going to yield returns over time, but it's not going to yield the returns right away. So we're not going to see the fruits of this type of investment for quite a while down the road. So it's a good thing that we're investing in this, but it's not a good thing when everything else is basically contracting. So everything else on the investment sector has contracted. In other words, if we were to just strike out this intellectual property right here, then we would see that the gross private domestic investment would actually contract here, okay? So that's a real big problem. But the biggest factor that is contributing to this gross private domestic investment, and you have to understand how these tables are constructed, is if we take a look at fixed investment right here, that includes your non-residential and your residential, okay? And they already accounted for this intellectual property product, and it's still contracted by negative 0.8%. So then it was your non-fixed investment that increased it. Well, where is that in all of this? Where is that in the gross private domestic investment? It's the change in inventories. That's all that it was. So basically, there was a buildup in inventories. There was just a buildup in inventories of goods here that contributed to this domestic investment here. And that's the only thing really that kept it positive, and it was a strong change in private inventories. That's really, to me, what is contributing to this real gross domestic product. So we're seeing a buildup in inventories, probably driven by a drop-off in spending on goods, draining from those inventories. And that's really the only thing that we're seeing that is contributing to a real positive GDP number here. Because when we take a look at net exports here, you can see that exports dropped by 2.5%, but your imports increased by 6.1%. So we're having a huge increase in a decrease in net exports. So that's taken away from the economy because your imports are higher than your exports. And when we take a look at government consumption expenditures and gross investment, the government component, we're not really seeing much of an increase in the government component. As I pointed out before, government spending has decreased in the third quarter on the total level, but that's all government spending, okay? So when we strip out the transfers of payments to people, that's what accounts for this factor here. This strips out those transfer payments to people and retirement accounts through Social Security, and it just takes into account what is the government itself purchasing for itself and investing in the economy. That increased by 0.8% versus a decrease of 2% in the second quarter. But look where it went. It's not in the federal level. It's not in the defense level. It's not in non-defense. It's at the state and local level. Now, in my opinion, if you're going to have a government investment, that's probably the best place to have it is the state and local level, as local as possible. I don't believe that government investment's really all that, adding to the economy, because it has to take resources away from the economy to put them back in. But if you're going to have it, the state and local level is your best bet there. But if you notice here, every component of GDP, so net exports, your government spending, your PCE, your consumption, is all less than this 2%. The only thing that is shoring it up is this domestic investment, and that's only the change in inventory. So it's because essentially businesses have ordered and purchased more goods, but they're storing them, and the inventories are not being drained. They're being built up at the businesses or at the depots right there, ready to be bought by the consumer. That is the only thing holding up GDP right now. If that starts to fall apart, if it gets to become a problem where businesses cannot acquire what they need to replace what is being consumed, then we are in real problem. So when we take a look at this PCE, the Bureau of Economic Analysis is saying, well, the real drop in GDP is because, well, we had an increase in private inventory. That was wonderful, right? And it reflected increases in wholesale trade. So that's before the consumer level. That's what I'm talking about here. But overall, the deceleration was more than accounted for by the slowdown in PCE. That's not really what's going on. Because if you had an increase in PCE, then you would have these inventories be drained from it, okay? So it would show up here and it would show with less here. What we are seeing is that the drop in consumption is causing the domestic investment to stay positive here, okay? Now, granted, it's staying positive with purchasing of inventory goods. So these goods will be sold. They're at the wholesale level and some stored at the retail level. At the retail level, that being built up, right? But this essentially dropping off in consumption will hopefully feed back into more resources being allocated to being able to increase all these other components of gross private domestic investment. So consuming less is what is being able to keep this positive, and hopefully if we keep consuming less and we don't get more government stimulus, we can turn these numbers positive, and then that might signal a real rebound in the economy because prices are dropping down, eating away at that growth. The last thing we want is to be caught in a bidding war where we're fighting with prices to acquire goods. That's how shortages develop, and that's how what the economist Ludwig von Mises called a crack-up boom, where we constantly see escalating prices and we're basically spending to keep up with the Joneses. We're spending on goods now to fight having to buy goods later in the future at constantly higher prices. So, and to me, this drop here is not a bad thing. This is a good thing. And we're seeing this being countered by an increase in investment, but whether that continues or not remains to be seen. My guess is that with the high levels of government spending that has been going on right now, that we are seeing here, which is higher than ever before, we're probably not going to get that. We're probably going to get continued price increases here, as well as the high amounts of monetary stimulus. Now, the Fed has signaled that they're going to stop the monetary stimulus or to taper it off. They're not really going to stop it. They're going to start tapering it back maybe as early as November. But until then, we're not going to get any relief from these bottleneck pressures. And if you look at it, government spending is still much, much higher than what it was at the end of 2019 pre-COVID. So until those government spending levels drop off even further, we're still going to have these discoordinations and these weird numbers effects going on in GDP. So a glimmer of hope possibly with this high domestic investment. Not good that it's in the private inventories, but if we get another quarter of low PCE growth, yeah, it's going to contribute to a low real GDP number. But if we get these numbers to start turning positive, especially on the fixed investment, we could maybe see in the future, coming quarters, a turnaround in the economy. We'll see what happens here, but certainly quarter 4 2021 is not looking good, not looking rosy by these numbers. And obviously, the major driver of all of this has been the monetary stimulus as well as the fiscal stimulus. So that's not looking too good either. We'll see what happens as we start coming into the next coming quarters and with the new economic data comes out, and I'll keep you appraised of that. So guys, I thank you for watching. If you like this video, just click the like button, subscribe to my channel already. If you have any questions, let me know. This is all very confusing. I probably threw a lot of data at you on this. So if you want some clarification, leave a comment, drop down below, or if you want to point out some things that I missed, I'm not perfect. If you see something that I'm missing, or if you want to just ask a question or anything, or just to create your own observations on this, I love to hear from you. This is a learning experience for all of us. The more information we have, the more that we can see of what's coming next. So if you can, just do that. I would greatly appreciate it. And guys, as always, thank you for watching, and I'll talk to you next time.